A coal and power cash machine can still deliver profits, just not as lavishly as before. Semirara Mining and Power Corporation saw net income drop to around 13.1 billion pesos in 2025, a third less than the previous year. Operating cash flow fell sharply to roughly 16.4 billion pesos from 27.5 billion pesos. For a company renowned for generous cash payouts, that drop stings. Profits might impress, but cash is what fuels dividends. Investors now see Semirara as more than a cyclical stock. It's almost an irregular annuity with surprise payouts. Despite lower numbers, Semirara declared dividends of 13.8 billion pesos in 2025. Still substantial though, less than the previous year. Parent operating cash flow slid to 8.4 billion pesos, well below the dividend payout. Bridging that gap relied on retained earnings, cash reserves, and subsidiary dividends. This year, dividends came not from fresh profits, but careful management of past gains. The biggest reason cash slowed was price normalization. Coal's average selling price fell 19%, while benchmark prices retreated further. The power business sold more electricity, a record, but at lower prices, creating a paradox: record production, record sales, but weaker cash generation. Working capital also posed challenges. Inventories ballooned as production outpaced shipments. Payables dropped, meaning less supplier financing. Receivables fell, releasing some cash, but more money was tied up in stockpiles. The market now watches dividends more closely than earnings. Semirara's payout pattern has been unusually generous. As of mid-April 2026, no new dividend has been declared yet, breaking the usual calendar and unsettling investors. Future dividends face clear pressures: falling earnings, subdued coal and power prices, regulatory uncertainty, and new losses from associates. Special dividends are now harder to justify as routine, given these headwinds. Panic isn't warranted. Semirara remains financially sound, with loans payable plunging and a better current ratio. Capital expenditure is set to fall, easing cash pressure. Production and power sales hit records, and contracted capacity shields earnings. Weaker cash flow sits atop a strong franchise, not a decaying one. Investors should avoid nostalgia and melodrama. Timing may slip, but what matters is converting production into cash. Semirara will likely remain an important dividend payer, but not a vending machine for specials. If prices stabilize, inventories monetize, and capex falls, dividends can still be respectable, even if extraordinary payouts are less assured. In commodities, exuberance vanishes first. Cash only if you're unlucky. Semirara's exuberance has faded, but the cash engine endures.